Okay, good morning, everyone. So this is actually part two of our discussion. I'm going to go through the capital markets PowerPoint slide, right? So let me just go through here. So we talk about the money market and then the capital market. So in the book, it's actually called the securities market. Basically issuance of securities like certificate of deposit and then IOUs or any T-bills, right? Now, remember, the securities market or the money market plus the capital market equals the financial market. Just want to make sure that we actually have that one. Now, the money market here, like as we see here, is actually the commercial paper, negotiable certificate of deposit, less than a year, 1 year or less than a year. Then the one that we talk about are actually the capital markets. So we're just going to go through um, making sure that we covered most of the stuff. Now, when you think about it, the stock exchanges in the world actually has a couple. So we have the New York Stock Exchange. We talked about it. It's a traditional exchange, national, as they say. And then these are like in millions of USD. So back in the end of 2020 after COVID, right? NASDAQ is the National Association of Dealers, right? Or stocks or securities dealers. And then it's electronically, these are electronic exchanges. And then this one is actually automated, no trading floor. NYSE has a trading floor. And then you have um, uh, SGX is Singapore Exchange, and then Japan, I forgot the actual term that what they call it. And then also Shenzhen is actually in China, and then Shanghai also. Then Japan has its own, and Euronext. So these are like the major global exchanges in the world, right? In the Philippines, I remember when I was here, I'm here in Manila traveling for work. Um, we have the Philippine Stock Exchange also that does the trading locally. So, which is actually this one. So when you think about it, each of the major countries with progressive economies will have a stock exchange. And then here's the listing for both the Americas, EMEA, we call it EMEA, um, Europe, Middle East, and then Africa, EMEA, right? And then Asia Pac. At one time, they called the Far East area, but as things grow, they call it now the Asia Pacific Group, and then the Americas. Now, the one that I would like to actually talk about is that there are money markets that we talk about securities, and the securities can actually even be a government securities, issue securities. So the government itself issues securities in order to fund itself. So you have the Fannie Mae, the Sallie Mae, the Freddie Mac. These are stocks, or these are not stocks, these are instruments or securities issued by government in order for for the government to get fundings coming from other people. Um, if you remember the 2018 global credit crisis, is the securitization of all the mortgage-backed securities that led to the collapse, right? So, but like, so that's why the government did the bailout back in 2018. And then, but if it's a US issued securities, these are normally secured. And then that's why, because it's backed up by the guarantee of the United States government. So you have the Fannie Mae, the Freddie Mac, Sallie Mae, and the Farmer Mac. Actually, this is new for me, the Farmer Mac. I've seen any student loans is Sallie Mae. Anything for mortgage is Fannie Mae. And then anything for federal home is actually Freddie Mac. Now, sometimes a municipal government, like say a municipality somewhere in San Francisco or somewhere in one of the municipals in California, can actually issue a muni bond. So we call it municipal bond or muni bond. So any interest earned on the muni bond, if you are in, say, California, issued by California, would not be, or one of the municipals in California will not be taxable for you. That's actually a good thing, right? Because normally any gain, dividends, or anything that you receive as money for tax purposes as a cash receipt is actually taxable. But there can be exceptions, like muni bonds, to make it more enticing for people to buy. And we talk about the major ones, the corporate bonds, debt instrument, then the preferred and common stock. That will be the equity instrument or equity financing. So this is the one that is actually a bit interesting, right? Um, so we talked about money market, capital market, which is part of financial market. And then on the capital market, you have debt financing and equity financing. So on equity financing, we talk about issuance of new stocks to the primary market. New, basically the first time. And if it actually circulates on the market, we buy it as retail institutional investors. That's the secondary market. Now, when you think about it, you as a company don't just use the new issuance of stocks to fund, right, equity. You can actually use your own internally generated funds. So what are internally generated funds? So remember, year over year, you make income, net income. And as you make that net income, it becomes, if it's unused, it becomes stored in your retained earnings. And then that retained earnings grow. Basically, that's your accumulated earnings from your operation. So some companies need not ask for new financing from a third party or external financing because you have internal financing source, which is actually your retained earnings. Now, depreciation comes about because why? It's a non-cash transaction, so you don't do a cash out. That's why it's part of the retained earnings. Remember free cash flow? If you remember the discussion that we have, or a quick calculation, it's earning after taxes. Then I need to add back depreciation. Why? Because depreciation is actually your non-cash uh, non-cash expense, right? So that's why a big portion of an internally this chart shows you that the big portion of the internal funds are coming from retained earnings, and then some are actually in depreciation, composition wise. So this one, the one in blue are actually representing depreciation as the composition of your or the usage of your internal funds, right? And then a big portion is actually undistributed. Well, the main portion is undistributed profit, and then some of the corporate dividend. Corporate dividends basically usage. Um, if you pay dividends, you actually use it out, right? So your remaining funding is only on undistributed profit. Now, this is the one I wanted to show, right? So when you look at the economy, but any economy doesn't have to be the US economy, there are interactions between the business, the government, and then the household. What are those interactions? The business would pay salaries and wages. When you graduate, you're going to work, you're part of the household. Then any business that you work for, let me just make sure I can use this, would actually issue a salaries and wages to you as the household. And then now you would actually save those money or anything in excess, right? You would actually save it. Or you would actually be using it to do purchase of goods and whatnot, to live life and whatnot. As part of that investment in or savings, you go to a financial institution. That financial institution either gives it to the business when the business needs loan, or it can give it to the government when the government needs some funds, right? So at the same time, the same household who actually got monies from the business And then the business would actually withhold the taxes. So remember, when you work, you need to pay the US government for what? Payroll taxes. Who's withholding that or who's taking care of that? The business would actually say, okay, you have $5,000, that's your gross pay, but let me keep, like, say, 1,000 of that because that's your taxes. So I'm going to give you 4,000 as your salaries and wages. But at the same time, the business would need to pay the taxes that it withheld from you to the government. And also any corporate taxes, corporate now, that the business actually need to pay the government, or any sales taxes that the business incurred as it does the business. And then the government in return either pay employees that are government employees, and then household also pays some of the taxes with the government in case that what the remitted amount by your um by your business is not enough to cover your taxes. Why? Because you as a household might have invested on a brokerage account. A brokerage account is not part of the business, it's not part of your salaries and wages. So you need to pay taxes on that one. So that's why there's also household taxes being paid. Or if the withholding tax that you paid is not enough to cover, you still amount due, then that's the portion that you need to go to the government. So it goes around the three economies. That's why when you think about it, the government should not just think about household, it should also think about the business. Um, because it actually is on both sides. That's why. Interestingly enough, when you look at studies, most of the fundings from the government comes from payroll taxes by individuals. And corporate tax might be small. Why? Because a lot of companies has corporate tax shields or ways or devices or strategy to not pay higher corporate tax. So it goes to the discussion of taxing the rich and whatnot. We would not go there. It's a different discussion, but I understand, but you understanding why taxation is important, because most of the major fundings um, for the government are basically based on individual taxes. When you make research, one of these days we will talk about it more. We'll find some time, but like those are good to understand, right? As interactions. I'm gonna go through. I'm gonna go through here. So they are ECN is the Electronic Communication Network. We talk about the New York Stock Exchange, which is owned by Intercontinental Exchange, ICE. And then we have also the ICE is the owner of the New York Stock Exchange. It's a traditional exchange. The ECN is how we do NASDAQ. So NASDAQ is the one that uses the electronic communication network to do dealings with dealers to trade stocks on a primary or secondary market. It's basically the structure. So to introduce a topic or a term, I know we have a lot of terms this semester, but like I just want to make sure that we actually understand that. So we talk about a national New York Stock Exchange or the NASDAQ regional Chicago Exchange, Stock Exchange, or the Boston Stock Exchange. Um, it's the same thing, it's just cheaper on the regional. Stock may be traded physically, New York Stock Exchange. It can be, here, New York Stock Exchange, traditional. It can be also non-physical or virtual, which is the NASDAQ. NASDAQ is the one that actually is being used by tech companies. Chicago, Boston, Cincinnati, and then the NASDAQ, it just gives you the idea of when was it founded and whatnot. So I'm gonna go through it. So these are the ICE is actually the owner of the New York Stock Exchange. It's called the Intercontinental Exchange. And then NASDAQ, you have the different markets on the NASDAQ. So ICE or Intercontinental Exchange started with futures. So futures is actually interesting as a concept, just a quick one. It's something wherein let me um let me set the price of uh like a product, a commodity. It started with eggs. Everybody wants to buy eggs on a daily basis, CME group. And then at one point in time, people would want to buy in bulk a week in advance or whatnot, but they want to set the price. So like, hey, can I buy you a big bulk of eggs? Or but like I'm thinking in the future it's gonna be this much. So can we set it at that price? But you guarantee that I will buy you this quantity. So that's when the futures trading started because of a commitment to buy a certain quantity on a set price that is actually allowed by the exchange. The exchange in a way also says that, okay, I have the price, and then you have set the price. I can commoditize that and securitize that by exchanging it with other exchanges. So as that concept grows bigger, so that's why you can tell that you would need to have a lot of requirements, or you would need to have a lot of regulatory requirements. I'm going to go through here. Some of them we talked about already. So CME, the one that we talk about as the eggs, is actually the Chicago Mercantile Exchange, right? Um, I'll talk about hedge a bit, right? So in the market, sometimes you want to do a hedge. A hedge is basically a cushion just in case to slow the impact or brace for the impact. For example, at one point in time, the interest rate is 8.5%. It's a bit high, right? Think about it this way. Your mortgage is fixed at 8.5%. Okay. Now, you would say that the exchange rate, the variable, so you're down for 30 years on your house at the fixed rate. But your friend who just recently got a house has a floating rate, a lower rate. It just floats. And then the rate is low right now. So you would say, hey, can I buy an instrument, a hedging instrument, so I can pay the interest rate that's floating, even though my original instrument, your original loan, is at fixed? What will happen is that you would only pay the floating rate because you're hedging it, but you need to buy that instrument. At the same time, somebody would actually get the rate that you have on the fixed and then sell it also as a hedging instrument for somebody who needs a fixed rate on a different market, might not be the one that you have right now, on a different market wherein the variable rate is high. I know that might sound a bit, well, I just want to give you an idea, but that might sound a bit too simplistic. But basically, hedging is somebody using an instrument to offset what they currently have. And then the one who actually sold you that instrument is actually using that also to sell it out, the one that you're fixed, to sell that out and securitize it so they can actually make money also out of it. So it's a lot of hedging on a bet, as you would hear it also in finance, in the world of corporate finance. So when you work with investment banks, in an investment bank, there's a lot of those hedging instruments, and then that's what makes people money, right? Because of the hedging. At one point in time, they were hedging on climate change, what will happen on weather, because hedging on weather can actually happen also. Weather derivatives happened in Enron. If you've seen that business case before, back in the days, there's a big company called Enron. That's why Sarbanes-Oxley got created as a regulatory wise, because Enron was audited. Those issues did not show up, and then they went through a very extensive type of products that are way too specialized that nobody really understands anymore. Revenue recognition, and then That's why there's more regulation that put in into securities. So that's a different topic for a different day, but good to know that you have all those things, right? I'm gonna go through here. So, so what's a efficient market? So we talk about securities, we talk about how the market moves and whatnot. So there are three types of hypotheses, right? A a weak form of a market efficiency is that the market only knows past price of the stock. So in a way, it's still weak, right? You could not predict the future because you only have past prices. Semi-strong, so the market understand the public information that's actually happening. And in the strong form, it knows both private and public information that would affect the stock price. So why are we trying to say um, the market, in theory, as built in during the trading, has a has all information included. So the stock price that was determined. So we say that right now, Nvidia or Tesla or Meta has a price at, say, depending on what the market ends, right? So what does the market know that we don't know? So the market, in theory, knows information. That's why it sets the price that way, right? So that's the reason why it sets the price. Now, if you have incomplete, so that's why the price is like that because it's the cost of the price or the cost of that information is built in. That's basically the theory. Um, what about insider trading? Insider trading, it can happen. That's why the strongest form of market efficiency that it accounts for both private and public information. But of course, that's on a theoretical level. So I just want to make sure it's a theoretical level that the pricing that you see played out in the market on the stock exchanges are based on all information that's complete. That's actually how the pricing works. Now, with all these things about the stocks, we have different prices on this, different regulation. The Securities Act of 1993 is actually the original one that they had. Um, if we actually have an original stock issuance, the Securities Act. Securities Exchange Act, if you have a secondary issuance, it goes to the secondary market. And then the Securities Act Amendment in 1975 makes a modification on the stocks, on the regulation of the securities that includes stocks. Now, SOX or Sarbanes-Oxley happened in 2022. The reason why it was introduced is because of some protection that happened on um, the issues that we had with regard to securitization. Now, the biggest update with, I'm going to look for the Dodd-Frank Act. Okay, so the biggest update that happened is actually when the market crashed back in uh, 2008, right? So that's why the Dodd-Frank Act, the global credit crisis, more institutionalization, more regulatory, um, regulatory requirements, because the government at one point in time bailed out a lot of big to fail, right? Too big to fail is financial institution, AIG as a bank, and then other institution like uh, I forgot the name of the banks, but like they have a lot of big name banks that they need to actually help out the government itself. So that bailout created the Dodd-Frank Act, wherein they said, okay, let me make sure that you would not be too big to fail by requiring them capital as a reserve to back up any transactions that they do, because the bank moves a lot of money. But if you don't actually have a reserve on that instrument, then if somebody liquidates and then it goes to a trigger and everybody wants to claim their money back at the same time, then you need to make sure that the bank is actually has a reserve. So think about a bank run. If you know that your local bank is closing because it's in bankruptcy, you would see a long line of ATM in the ATM machine because everybody's going to withdraw the money or online, right? Or depending if you can access online. So it will be called a bank run. So the US government, through the legislation and newer legislation, wants to make sure that any type of instrument that would actually be issued out would actually have the proper reserve and compliance requirement and reporting requirement and other regulatory requirement to protect you. Now, I wanted to make sure that we had the second one to give you an idea of the on the book, but don't forget to read the book, okay? Um, so this week, on week number 9, we don't actually have a quiz, which is a good thing. And then for the students, so we would actually have the quiz on week number 10. But for now, we just want to make sure that you have an idea what's the market, the capital market, the money market, and then also the financial market. And then that's basically the discussion for this week. So I owe you guys your quiz. So let me work on the quiz. I'm gonna answer. I'm gonna check on it, and then I'll post the grade soon. But hopefully that helps you out with understanding. Please do read the book as well. It helps you to reinforce the information. But thank you everyone, and have a good week.